Welcome to Manage Your Damn Money with Ben and Malcolm, where we trade in personal finance advice for entertaining conversations about money, millennials, and the young at heart. Welcome, world, to yet another episode of the award-winning television show and podcast, Manage Your Damn Money with Ben and Malcolm. I am joined here by my co-host, Mr. Malcolm Ethridge, licensed financial advisor. Sir, what's going on with you today?
I'm good, man, and good job. Get those awards in there.
Hey, man, I'm getting better at it. I promised I would improve upon that area, just as I've also promised myself secretly I would try to remove ums from the show entirely at some point.
Good luck. That's a tough one.
I'm getting better, actually.
Okay.
I noticed over the last, 20 or so shows.
You've been reviewing the game film?
Just a little bit, just a little bit. So anything new with you?
Man, I'm just trying to hang on, okay? It's been a crazy...
Trying to stay healthy?
Trying to stay healthy, trying to stay sane is more likely. It's been a crazy few weeks at this point.
That's true.
Work-wise.
That's true.
And obviously we'll get into that a little bit with this show, but
yeah,
that's what's happening in my world, man. Just trying to hold on.
As Malcolm alluded to in this episode of Manage Your Damn Money, the conversation at hand is how markets and our money moves when world events happen. And Malcolm's world has been moving and shaking as a financial advisor.
Rocked is the way to say it.
It's been rocked. Well, very good. Well, I have something else I want to share real quick. Has nothing to do with anything that's going on or what we're going to talk about in the show, but I had a very big boy adult experience recently.
Okay.
The main sewer line at our house was clogged.
Okay.
Which means all the things from the second floor up go to this particular line that, everything drains through there, and it was clogged. So I had to call the plumber.
Okay.
$589 to snake the main line, which took dude maybe 7 minutes total. I was so hurt. And guess what clogged it?
I'm going to guess something related to one of the girls.
Oh, wow. That's very perceptive of you. Baby wipes.
Okay.
Guess who was putting baby wipes in the toilet?
I'm hoping it was one of the girls who are...
Yours truly.
Okay. So you ate that $585 because it was you that...
Something like. It was definitely my fault. It was one of those things where it's this is a good lesson. I didn't know you couldn't put baby wipes in the toilet. I just assumed because, it's a toilet and it takes other things. It should be able to manage to take this. So I won't be doing that anymore.
I see.
But that was my first homeowner, big expense thing that
you could buy a snake from Home Depot.
And that
Lowe's
was I need to just go do that because clearly inviting a plumber over to do stuff is just way too much.
I mean, it's $40.
Are they that cheap?
Yeah.
I haven't even looked.
They're made out of plastic.
Aren't they made out of metal?
The snake itself,
yeah.
But the winder thing, this is just a hunk of plastic.
All right. Well, that'll be the solution next time. Some lessons are worth paying for. I don't know if this one was.
I don't think so.
I'm gonna say it was though. But before we get into the rest of the show, as we do on every show, it is now time for headlines. Dow craters 1,500 points, and the S&P 500 is down 6% after trading resumes. And this was a March 8th, 2020 piece on CNBC.com by Yoon Lee. And we're dating it specifically for a specific reason because of a particular point in time, which we're talking about this. Stocks tumbled on Monday as investors braced for the economic fallout from the spread of coronavirus, while a shocking all-out oil price war added to the anxiety. The Dow Jones Industrial Average tanked 1,500 points, while the S&P 500 plunged 6.6% in the morning trading of that Monday. The massive sell-off triggered a key market circuit breaker minutes into the opening bell. Trading was halted for 15 minutes until reopening at 9:49 a.m., Malcolm. So first question about that, because I think that's an interesting thing. What does it mean when it says there was a halt to trading?
So essentially, if you think about the way that your house works, the electrical system in your house, you use the term circuit breakers, and that's technically what they're called.
Okay.
It basically means when a certain point of your house, there's a surge of energy going to one place, that circuit gets cut off.
Okay.
And the same thing happens in the stock market where there's a surge of trading in either one particular name or the entire market. They have the ability to just shut the whole thing off, basically to hit the reset button.
Okay. So is this something that's new? Because I feel like it Is that like a new implementation, or has that always been?
Depends on your definition of new. So after the crash in October of 1987, which was dubbed Black Monday at the time because the market lost, call it 20-ish, 21, 22%, something like that, just in one day, and it had never happened in the history before.
Right.
That's when these circuit breakers were enacted.
Okay.
So, I like to think that I'm still young. I personally was born in 87. So it depends on your version of new, what your vantage point is.
No, sir, but continue on.
But that essentially is what triggered creating such a thing.
Okay, and that could happen for individual stocks, and it can happen for, as I understand it, for the entire stock market. Is that correct?
Correct, yep. So if it's an individual stock and let's say some information leaks, like for example, the CEO is tweeting about the company, something that they shouldn't be, a la Elon Musk and Tesla. Those kind of things can happen to that one particular stock.
Okay.
Basically, if you think about it in practical terms, it's like when you're watching a sporting event and one side starts to gain way more momentum than the other team likes,
they call
just call a quick timeout, reorganize, get their strategy together, and then in that period where nothing is happening, they feel like at least they're able to come back to it with a little bit clearer head and do something about it.
Obviously, it works in the direction of when things are falling. Does it work when things are like shooting up to the top? I've never seen that before.
I'm sure in theory that exists, but I've yet to see it implemented on an up day.
In that direction,
Yeah.
Okay. Well, the article went on to say that the sharp decline followed a roller coaster week that saw the S&P 500 swing up or down more than 2.5% for 4 days straight. While Monday's drop was significant, it still didn't crack the 20 worst days for the S&P. Investors continue to seek safer assets amid additional fears that the coronavirus will disrupt the global supply chains and tip the economy into a recession. The yield on the benchmark 10-year Treasury note dropped below 0.5% for the first time ever, while the 30-year rate breached 1%. And then Saudi Arabia, to kind of make things worse, on Saturday slashed official crude selling prices for April in a sudden U-turn from previous attempts to support the oil market as the coronavirus hammers global demand. The move came after OPEC talks collapsed Friday, prompting some strategists to see oil prices crater to $20 a barrel this year, which is, I remember like growing up in the summers in LA, they were like news stories about barrels being like $100 a barrel. And that's when like gas was like
10, 115.
And to say it's like now 20 is just like, wow.
Somebody tweeted, I can't remember which day it was now, but let's say like 2 days ago, a picture of like a Target ad for Charmin toilet paper, and it was more expensive than a barrel of oil. And they were like, that's how lopsided the world has become.
That's
that
crazy.
Toilet paper is worth more than oil to us these days.
Well, you've sort of been, and maybe not on this show, but in our conversations, you have been kind of sort of calling for some sort of recessionary moment because we've been in a 10, 11-year bull market, which means things have been going up for the last decade or so. I kind of thought you were that guy who, if you just say the same thing long enough, eventually you'll be right. Like you could be like,
I was the doom and gloom.
it's gonna rain.
Yeah.
I'm telling you, it's gonna rain. Well, of course you'll be at some point you'll be correct.
That's fair.
But how do you explain the arrival of a recession or potential recession? Because we don't know that that's what's actually happening here, but there's a lot of talk of it being brought on by world events as opposed to economic ones.
So there's 2 points to it. One, you're absolutely right that part of it was me saying the probability of us continuing on this course, based on the fact we've been on this course for 11 years, is a lot less likely than it was 10 years ago, 9 years ago, 8 years ago, so on and so on. There is absolutely something to that. But there's also the fact that like I was just looking at how the market is structured and what is driving it up. And so to not get super wonky on this, essentially what is happening is on one hand, interest rates are extremely low, which means that companies are borrowing money. The thing they're choosing to do with that money is to buy back more shares of the stock that is out there outstanding in the market to prop up the price of the stock price. Because the fewer shares that exist, the more valuable the ones are that are still out there. And so they're basically just taking cheap debt on one hand and buying their own stock to inflate the price of the stock on the other hand.
And that's not a natural like increase in value.
No, it's an artificial increase in value. And then also you have to consider somebody is buying the bonds that they're selling in order to increase the value of their stock price. And so when you see things like that happening, it's not really built on anything. And these are the kind of environments where, like you said, something that happened that's completely separate and apart from those economic fundamentals that I just gave you. When those things happen, it shows you like the underpinning of the market just really doesn't exist. Like we would like to feel like it is.
In those big and high moments when things are on the up and up.
Right.
I had a thought though when I was looking at the news about coronavirus and how it was impacting the markets and whatnot. Things have fallen over the last, about a week as we record this particular show. I was thinking about like if this were to bring on some kind of recessionary period, even let's call it like 1/4 of what we experienced in 2008. I was like, how poetically, incredibly ironic would that be for the millennial generation in particular to have gone through a recession at the beginning of their careers and then again in the middle of their careers? Like, to me, I'm like, we're doomed. That's it.
Well, so to make sure that we're all starting from the same point, let me just use some of my corporate jargon here and say, let's just level set here for a second.
All right, let's level set.
So recessions happen frequently.
Yes.
Recessions basically just mean that there's 2 consecutive quarters of negative growth in the overall market. So, 2 consecutive quarters is 6 months.
Right.
It is very likely that you could have 6 months where things are happening that just, it's not a good time for people to be making money, to be running businesses and so on. It's usually every 7 to 8 years, you'll have, the peak to trough cycle where you're falling into a recession and you're coming out of it and things are great and then it's falling off and then recession again. So you're likely to experience 5 or 6 recessions, over the course of your lifetime. The difference is just, to your point, we experienced what we called the Great Recession because we weren't allowed to call it a depression because technically we were like a month shy of, enough quarters of negative growth for it to fall into depression status.
It was just that short?
It was that short. So they called it the Great Recession instead.
Let's downgrade one.
So it was a significant one, to your point, but recessions are going to continue to happen throughout the course of our adult lives. It's just kind of natural for the markets to go through those cycles.
Right. And quickly, before we go to our first music break, how can seemingly unrelated world events have such an impact on markets in specific ways?
Well, essentially what happens is people hear things.
Yes.
And especially with social media being what it is today.
Yes,
so you have a lot of Instagram financial advisors out there. You have a lot of folks who are on TV saying and doing a bunch of things that are counter to what the person who was just on before them said and did.
Right.
And so the public as a whole is just confused.
Right.
And so a lot of times people feel like, first of all, we like to feel like we're in control, even though we're not.
Right.
If you think about it in the same terms as like going to a casino, people feel like because they blow on the dice before they roll them, that somehow means that they're gonna roll a 7 instead of a 6 that one time.
This is it.
We have zero control, frankly, over how the overall construct of the markets work.
Right.
But people feel like I have to be doing something so that I feel like I'm taking control of the situation, because I don't like feeling like I'm out of control and I don't have the ability to settle it. And so once these world events happen, it causes people's panic to rise up, and then they start calling themselves taking action.
Right, indeed, indeed. We're going to take a quick music break, but before we do, I want to remind you can catch past episodes of Manage Your Damn Money on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. Please leave us a rating and a review on any of those platforms. That helps more people catch the show. If you have a question or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. And of course, if you want to follow us on the gram or on Twitter, my handle's @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And of course, you can catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm, where today's conversation at hand is how markets move and our money moves when world events happen. There are moments in time which have an impact on our finances that are completely outside of any one person's control. We are decidedly inside of one of those moments that meets that criteria, Malcolm. The coronavirus, or COVID-19, has sent markets reeling. And there are growing concerns that the spread of this particular pathogen could send the global economy into a tailspin. On this episode of Manage Your Damn Money, we are taking a look at how markets and our money moves when world events have an outsized impact on economies and our pockets, Malcolm. So just a real quick recap for those, if you're just so happen to be like getting out from under a rock just this moment, you turned on this episode of our show. There's a virus that's going all around globally, which people are really concerned about because it has like a higher level of I guess what would be the word, virility?
Casualty.
It has an it's what's a good word for it? I'm trying to be like politically correct.
I don't know what the word you're looking for.
Anyway, it's not good to get, particularly if you're an older demographic, because you're more likely to go on to glory. There we go. As a result,
That's what you were searching for?
that was the thing that was in the box right there.
Essentially, it's an infection in your lungs, in your respiratory system.
Right.
And older people tend to have more compromised lungs and respiratory system.
You had it right there.
I didn't understand
You
what
had
you
it.
were searching for. Like,
So essentially, it's been spreading around, and it's created a situation where people are now concerned about its effect on economies globally and in the United States. So Malcolm, what has the conversation been in the wealth management world about coronavirus specifically and how it's impacting folks' money and markets generally?
well, a lot of the conversation I'm hearing this week so far has been about like what happens if this prolongs further. Yeah. So a lot of times, like the conversation that we have with clients in this day and age of trading is about the fact that like so much of trading happens by computers these days. So it's not really how you think, your next door neighbor is selling, so you should sell too. Like in the grand scheme of all of the money that there is in the stock market, you're not even like a rounding error as far as your account value is concerned. And I say that broadly, like it doesn't matter how much you personally have until you start getting into the hundreds of millions of dollars. And even then, you probably still don't really move the market like that.
Right, like Jeff Bezos level.
Right. So if Jeff Bezos started selling his Amazon stock, that would have a huge impact on the market itself.
Okay.
But until the guy who owns, I'm just going to say 50% of all of the Amazon stock that there is out there, then it doesn't really move the needle enough for it to really start to impact the overall markets. So with that said, it's a lot of computer trading that happens on behalf of like mutual funds, pension funds, things like that, where really large blocks of individual stocks or individual bonds are being traded. And that, again, happens a lot by computers these days. So the conversation has kind of shifted from that now to this seems to be a little bit more than just the algorithms have taken over.
Right. And
what do we do if this lasts, a few months instead of a few weeks like we anticipated initially.
Right, definitely. Well, a piece that we pulled for this particular story, stock market crash. It's a stock market crash, its causes, effects, and how to protect yourself. This was a December 2019 piece on thebalance.com by Kimberly Amadeo. It reads, a stock market crash is when a stock index drops severely in a day or two of trading. The indexes are the Dow Jones Industrial Average, the Standard & Poor's 500, and the NASDAQ. Malcolm, so quickly, is what we've seen over the last couple of weeks, does that qualify as a market crash?
It does. It's a little more prolonged than what the piece you just quoted says, because it's been, a couple of weeks we've been in this, but it's definitely considered a crash.
Okay. And a crash is more sudden than a stock market correction. When the market falls 10% from its 52-week high over days, weeks, or even months. Each of the bull markets in the last 40 years has had a correction. It's a natural part of the market cycle that wise investors welcome. Such a pullback allows the market to consolidate before going toward higher highs. No one welcomes a crash because they are sudden, violent, and unexpected. So this goes far beyond at least what we've seen recently.
Emphasis on violent.
Indeed. Frightened sellers, as Malcolm alluded to, cause a crash. An unexpected economic event, catastrophe, or crisis triggers the panic. And in this case, we're talking about coronavirus doing that. For example, the market crash of 2008 began on September 9th, 2008, just after Malcolm bought his house in North Carolina, when the Dow fell 777 points. It was the largest point drop in the history of the New York Stock Exchange at that time. Investors panicked when Congress failed to approve the bank bailout. They were afraid more financial institutions would go bankrupt the way the Lehman Brothers had. And then a couple of causes for crashes. Crashes generally occur at the end of an extended bull market, which Malcolm alluded to, 11 years, and here we are.
Yeah.
That's when irrational exuberance or greed has driven stock prices to an unsustainable level. I actually had seen the 26,000 number and 27 as it was approaching. How high did it go, the Dow?
We crossed 30.
We crossed 30?
Yeah.
I was looking at that like, that looks ridiculous to me. Like, just in terms of like what it had been and where it was and the amount of time it got there, it did look ridiculous to me. But anyways, at that point, the prices are above the real worth of the companies as measured by earnings. The price to earnings ratio is higher than the historical averages. The end of the dot-com bubble in 1999 caused the NASDAQ to crash in 2000. A new technical development called quantitative trading has caused recent crashes. Quant analysts use mathematical logarithms in computer programs to trade stocks, as Malcolm alluded to. Sophisticated investment and hedge funds with thousands of computers have been programmed to sell when certain events occur. Program trading has grown to a point where it's replaced individuals' investors' greed and panic as causes of crashes. So I wonder what happens when you put those things together with actual causes of fear and all that kind of stuff. So real quickly, Malcolm, what's the difference between a market correction, though, and a complete crash of markets?
Well, the correction, as you mentioned, is really just where things aren't necessarily explainable.
Right.
And so all of a sudden you just see things just not even cool off is the term that we use. So 2019, for example, the market just kept going in a straight line, basically. And there was no real justification for the days that we had where things just stopped going up in a straight line.
Right.
Nothing really happened any differently than the day before.
Right.
Just suddenly folks were not only not buying anymore, they started selling.
Right.
But then a week goes by and all of a sudden people have completely forgotten about it and just, we keep on going. A crash is a completely separate example where something significant has happened and you can directly point to it and go, that's the reason that stocks are falling.
All right. Have you ever thought about how world events, and I mean, we talk about the kind of the human element of like, I got to do something because there's something happening and I must react to it. That's one thing. But how could world events be coupled with computer logarithms to like create a situation where, markets are tanking?
Well, I mean, you kind of alluded to it as you were reading the piece where people have programmed their computer trading systems, and I'm oversimplifying it, but people have programmed their computer trading systems with like 100,000 different if-then statements that say, even if, like, for example, something as innocuous as if Donald Trump tweets the name Bernie Sanders more than 32 times in one day, sell so-and-so company.
Sounds possible.
Right, but I mean, it's so out of the box, but somebody's strategy is based on Donald Trump's Twitter, this is not even a joke or an exaggeration. There is actually an ETF out there that tracks Donald Trump's Twitter and buys and sells stocks based solely on the number of times a name or a phrase appears.
I wonder what the returns are on that one.
I haven't even looked at it. That's actually a good question. I haven't looked at it recently to know. But those are the kind of things that are set to like automatically trade the market on our behalf. But what also happens is the computers are talking to each other, right? Like if you think about autonomous driving for a second, all the different cars that are driving autonomously have to talk to each other. That's the same thing that's happening in the markets with all these algorithms where I say, okay, well, my mandate is if the market gets to X, I'm going to sell a third of my shares of Microsoft, for example. Well, yours might say, well, if Malcolm sells his Microsoft, then you need to sell yours too, and so on down the chain. And that's the reason that we have to have things like circuit breakers in place to save us from the robots, believe it or not. Like, that's the more amazing part of it all to me.
Indeed, indeed. Flipping this a little bit, we're talking about the market crashing. And I think you and I, because in our conversations, we talk about this on a weekly basis, so it's a little bit different for us because we're like in it regularly. And you, of course, do this for a living every day. How are wealthy people feeling right now that there is a market crash, or maybe someone might say market opportunity
Right.
on the table.
I was going to ask the question of how wealthy are we talking,
Well,
but you kind of just answered it with that because a lot of times people who are wealthier tend to have larger piles of cash, and I don't literally mean Scrooge McDuck vaults of cash in their house that they're swimming in, not even cash in like a savings account at the bank. I mean more so cash-like instruments is the term we use. So a money market fund or something like that. So they tend to have pretty large positions of money market funds sitting inside their investment portfolio somewhere so that they can take advantage of opportunities like this. So Berkshire Hathaway, for example, which is run by Warren Buffett, I don't remember where he falls on the world's wealthiest people list.
He's up there though.
Let's say he's in the top 5,
right?
Warren Buffett, at last check, I want to say a week ago, I was actually paying attention to this. Berkshire Hathaway was like 19.5% in cash. So that tells you that they themselves were waiting for the opportunity to go into the markets and start to buy companies that they thought the fundamentals haven't changed, but because people are foolish enough to start selling, it's time for me to be smart enough to start buying.
The visuals I had is like a lion killed like some prey, and then the vultures like up in the branches waiting to like get at the carcass afterward. So really, if people have a lot of cash on hand, wealthy folks, generally speaking, this is a different moment for them than it is for like folks who are watching their 401ks and whatnot.
100%. Right? Well, folks who are wealthy tend to already have sort of their bucket of funds that are not going to be impacted by the markets because they're in something that is extremely safe and is going to cover a few years of living expenses. And then everything else is for my kids and grandkids and what my charitable, desires and all that kind of stuff. And then also some of my speculative money that I just want to gamble. And the way that I gamble as an oil tycoon, for example, is going and buying up, a bunch of companies that, again, the fundamentals haven't changed. So for example, Amazon is still going to have 2-day shipping tomorrow, the same way they had 2-day shipping 2 weeks ago, and the same way they had it at the beginning of the year. Amazon, for all intents and purposes, shouldn't be being traded down just because there's a virus breaking out that is causing people some respiratory issues. But it is. And so if I'm one of those wealthier people you're talking about, and again, I'm oversimplifying, but I'm looking at like an Amazon, for example, and going, I could buy it here. It's on sale is the way that I look at it.
On sale. All right, well, we're going to take another music break. But before I do, I want to remind you can catch Manage Your Damn Money as a podcast on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. Please leave us a rating on any of those platforms. That helps more people catch the show. Please go hit that button right now. It must be a 5 or nothing else. And of course, if you have a question you want us to cover or a topic you want us to hit, send it to us, info@manageyourdamnmoney.com. And of course, you can catch us on Twitter and Instagram. My handle's @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And you can always catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm, where today's conversation at hand is a very timely one that I think is appropriately suited for our show, Malcolm. How markets and our money moves when world events happen. And I actually want to continue that article that we mentioned earlier, which is titled Stock Market Crash, Its Causes, Effects, and How to Protect Yourself. The effects, first of all, of a stock market crash. Crashes can lead to a bear market. That's when the market falls 10% beyond a correction for a total decline of 20% or more. It typically lasts 18 months. Bear markets occur usually with a recession, Malcolm. So can you quickly define the difference between a bull market and a bear market and why those terms are used?
Yes, it's going to sound extremely stupid when I tell you why those terms are used, but
Okay.
A bull market is when the market is going up, and a bear market is when the market is going down. The reason that those terms are used are literally because a bull, if you think about a bull standing on its four legs, its horns are pointing straight up, and so that's why you also see bulls and bears. The horns on the bull are what tells you.
That makes, I guess, some sense, but why?
Because the bear, when he's standing properly, his paws are pointing down at the ground. Like I said, extremely stupid. That doesn't even make any sense. They both have four legs, which are on the ground, but that is the reason.
Okay, so moving on, learn something new every day. A stock market crash can cause a recession. How? Stocks are how corporations get cash to grow their business. If stock prices fall dramatically, corporations have less ability to grow. Firms that don't produce will eventually lay off workers to stay solvent. As workers are laid off, they spend less. A drop in demand means less revenue. That means more layoffs. As the decline continues, the economy continues to contract, creating a recession. In the past, stock market crashes preceded the Great Depression, the 2001 recession, and the Great Recession of 2008. So it kind of describes it in a cyclical fashion. Like one thing happens, and then it puts stress on one system. That system puts stress on another system, and then pretty soon the system is trying to shed itself of responsibility such that everyone can survive, which makes it harder to survive. So that's kind of what that means. So at what point, Malcolm, do we know, okay, we are officially entering a recession?
So that's what's really interesting about this is that you really don't know you're in a recession until you've already been in a recession. So you have to be able to point to dots on a graph and plot it out to say, okay, it made this U shape or a V shape that told me we were in a recession at the time. I thought maybe we might possibly, you know. And so looking backwards is the only way that an economist can begin to tell you that you were, in fact, in a recession.
That's not encouraging at all.
Right. So you have to at least know what the markers look like and feel like in order to kind of act accordingly.
Right.
So interestingly enough, I may or may not have ever even mentioned it on the show, but I worked at Home Depot in college, for example.
If you ever did, this was a long time ago.
So I worked at Home Depot in college my sophomore year. So it was 2006.
Okay.
And going into 2007, all of a sudden, we stopped having people coming into the store to buy stuff. So I'm working at a home improvement store. A lot of the folks that were coming in at the pro desk that I was working at were contractors. Contractors at that level are building houses or working on houses one-on-one. They're not building large swaths.
One job at a time.
Right. All of a sudden, those people start disappearing. That should have been an indicator that
for you.
All of a sudden things are slowing down. I'm getting every week when I come into work, I'm getting the chart that says you've got to cut some hours.
Right, because you were managing people.
So I was a supervisor in my department, and so they're saying like you got 8 people. We really only need 6. If you refuse to fire 2 of them, you're gonna have to just cut people's hours. And then it became less hours and less hours and less hours, and so it should have been. In hindsight, I can see it now, but it should have been a precursor, what we call a leading indicator, that things were, in fact, already recessionary, but we just didn't realize it.
Malcolm, you managing people and doing schedules in college in 2006 with your clipboard and glasses.
It's really weird. Like,
it's really
I didn't wear
hilarious
glasses back then.
You didn't wear glasses?
First of all, like, don't. My eyes didn't get bad until my senior year.
Okay.
But it's really weird being 19 telling 50-year-olds when they can go to lunch.
Oh my
God.
God.
That is extremely weird. But I learned a good bit that obviously I can apply now. I just wish I had known a little bit more back then.
That's
and
hilarious.
been able to see it coming.
That is interesting to see how the impact was actually ground level for you to see. Just without the experience, you didn't know exactly what it meant. So some things what not to do in the crash from that article that we were referencing. During a crash, don't give in to the temptation to sell. It's like trying to catch a falling knife. A stock market crash will make the individual investor sell at rock bottom prices. That's the precisely wrong thing to do.
So if I can bring him back to the show one more time, and this is not the Warren Buffett show, but as you can tell, I study a lot of his mantras because he's in that top 5. The famous notion from Warren Buffett is to be greedy when others are fearful and be fearful when others are greedy.
I saw that today on Instagram.
Which is also the reason why I mentioned that, as of 6 months ago even, he was building up his cash hoard because he was saying these people are being way too greedy.
He was getting ready.
And so I'm being fearful.
Right.
And so now that, we've gotten to a place where others are being fearful,
and it swapped.
It's time to start being a little greedy.
It's such an easy thing to do if you can divorce yourself with the emotion of the moment.
Which is the hardest thing to do, which is why I even have a job in the first place, is to help talk people off the ledge and keep them from shooting themselves in the foot.
Right. Well, the stock market usually makes up the losses in 3 months, the article reads. When the market turns up, they are afraid to buy again. As a result, they lock in their losses. Most crashes are over in a day or two, and in most cases, sit tight. If you sell during the crash, you will probably not buy in time to make up your losses. So how do people, Malcolm, end up hurting themselves? This article says lock in their losses. How do people hurt themselves when they take action during a market downturn?
So the term lock it in, whether it's a gain or a loss, basically means you decide to sell at that point.
Right.
So if you think about it, I used Amazon already, so I'll use them again in this example. If I bought Amazon for $10,000 and Amazon on my statement when I look at it every month says it's worth $15,000, I've got a $5,000 gain on paper.
Right.
The moment I decide to go ahead and sell, I have locked in that $5,000 gain, and then obviously the inverse. So in this case, you really haven't lost anything until you decide to sell and lock it in. But the moment you do go ahead and hit the sell button, you're done. And you're also at the risk of not catching whenever the next up day is. And so I mentioned that I've been on the phone quite a bit the last week and some change. A lot of it has been throwing people's logic back to them and just saying, if we sell today, what is the point that you need to see to determine that it's a good time to get back in? Because just how you're telling me you can time the right time to get out, you've also got to perfectly time the time to get back in. And almost no one has ever done that in the history of the stock market, which is why we always say you're in a much better place to just go ahead and let it ride, unless you really need that money for something today.
Excellent. So generally speaking, in what ways do we see a crash hurt our own financial efforts, Malcolm? I think this is the one that people can relate to the most. 401ks, 403bs, IRAs, and maybe 529 plans. People might be accustomed to logging into seeing those like different kinds of accounts, be they retirement or college savings accounts, and they're used to seeing it at a certain point, and it's only growing up from that point. They log in during a period after like what's been going on with the coronavirus. They would see what? They would log in and see what?
They would log in and see less than they had the day before, call it 20%, in some cases less than they had the day before, or a couple weeks before. But I would just say that, again, I alluded to it, but I would say keep in mind what the funds in that particular account are set for. So you pointed out 401k, 403b, IRA. Those are 3 retirement accounts. So if I'm a 32-year-old who is not going to be retiring for the next 35 years, I have no business selling today and worried about what it's going to be worth 35 years from now. But I do also run the risk that I sell today and I'm sitting in cash for 35 years because I forget all about the fact that I'd made that trade and never went back and did anything. And the 529 plan, like you said, if your kid is 2 years out from being ready to go to college, well, now this concerns you. But with that said, I would also say if at this moment, you are now starting to rethink your investment strategy. Although all the way up, you were like, oh, okay, this is great.
This is
like,
cool.
I'm really enjoying it. You shouldn't have been taking on that amount of risk in the first place.
Right.
And this is kind of that smack in the face to remind you of that.
Right. Other ways that you might see it impact you directly, individual stock buys take a hit. I know for me, when I open my stock app, I've been seeing red all across the board. I look at it, I smirk, and I go on about my business and what I've been doing at least these last few weeks. And also, as a market downturn continues, you may see it translate into a true recession where employment prospects are affected by the lack of access to capital via stocks and a lack of consumer and business confidence in what's happening in the economy. And I believe you begin to see is businesses start to pull back in terms of what they're spending on and what they're doing because they're not sure of what the business landscape is.
Banks aren't lending to those businesses anymore.
Precisely.
The way they used to.
Precisely.
So the businesses have to cut some labor hours, like
Indeed.
we started talking about. All those kind of things happen.
Indeed. So another question for you, Malcolm. Looking back on the Great Recession of 2008, what were some of the ground level effects of the market downturn, and what were the outcomes felt by like regular folks on, as politicians say, Main Street?
Well, a lot of it, I started out with it, but a lot of it happens from the banks, unfortunately. Like, they're that much intertwined into our lives. So you've heard me multiple times on this show talk about how we are so dependent on borrowing in this country, and our ability to consume is based on our ability to borrow. And so the moment that those banks say, I'm not gonna let you have, $20,000 outstanding on your credit card the way you did before, I'm gonna cut that off at 10 because now I'm concerned. All of a sudden, that just took $10,000 of buying power away from you that you were actually planning to use for something. And that has completely upended the way that you run your household budget. Those kinds of things, or you needed to go buy a new car, for example, and where the bank would have said, spend $35,000. Go get a whole new Dodge Charger, whatever. Like, now they've come back and said, we've got 25 for you. Be a little more responsible. And then so those kind of things have an impact on all of the other pieces that touch them, like the salespeople at the dealership, the manufacturing plant, all those kind of things where demand has slowed because the banks have stopped lending because everybody has to borrow to live their lives.
And it's a domino effect from there. So how do people resist the urge to sell off portions or all or any amount of their portfolio when it comes to a market tanking or going down for an extended period of time? How do you resist pulling the trigger?
I don't know. I mean, frankly, I think a lot of it is like deleting the app that gets it in your face. Because, if you think about back in the day, quote unquote, you didn't always have online access to your accounts. So you didn't have immediate access to information the way you do now. And so you had to wait until the month closed to look at your statement to say, oh, okay, well, I see where things kind of fell off in the middle of the month, but all of a sudden they made their way back and it's not so bad. Or the month closed out and you went, oh my God, like, I can't believe I lost this much. I've got to do something about this next month. But at least moment to moment, you didn't have the ability to just jump online, place a trade in 40 seconds, and then whether you regretted it or not, that decision was already made and you've already locked in that loss.
I personally, for me, just in my own investment journey from 18 or 17, whenever I started, to now, the thing that has helped me resist pulling the trigger when I shouldn't, either when I have major losses or a situation like this where there's an event that's affected the market, for me it's just been the experience of knowing that these things happen and I can't necessarily react to them. So I don't really have any emotional reaction to the loss of money on paper in that way because I've just seen it happen so many times. And I've also held losses as a result of that. But I'm still, as you say, in the game, and I can still technically at some point possibly recoup that loss if whatever I have comes back.
I don't need, so it's probably sounds like I'm lying when I say it. I can't tell you what my account did today or yesterday or the day before. When I start my day and I turn on my computer, on my terminal, all of the accounts that I manage are successively in a line. I don't even look at my own. For what? I'm not gonna do anything about it. So for what?
Yeah, indeed. So let's assume, this market downturn is the introductions to, for millennials' sake, hopefully a small hiccup in the growth of the economy, and things might need to take a cooling off period. What are some things people can do to kind of prepare themselves for a recessionary or recession-like period in the economic situation?
Yeah, so I think, frankly, your job prospects are the most important part of the entire equation, because we just immediately started talking about how folks in the back room, quote unquote, are looking at, okay, what if this gets really bad, or if it looks like what we think it will, who can we cut so that this gets lighter on us?
Yeah.
Who can we go to make sure that this isn't going to drag us down too much?
Right.
And I think making sure that, that emergency fund that we always talk about being a rock solid piece of your financial plan is actually in place, and understanding that this is the reason that you have it in place, but also looking at options, right? If today is the day and I get called by my HR department and they say, at the end of the month or tomorrow, we're going to let so-and-so department go, and that includes you, actually being ready so that you have a meaningful plan for what do you do if that day does come.
That's true. I've been thinking about that myself, just in terms of what that would mean for me. For me, I'm looking at it through the lens of being a parent now, and I'm like, oh man, this has huge implications for it. It was one thing when you, as a single young person,
I don't need no food.
I don't need to eat.
I don't got to go anywhere.
I don't need a house. I can sleep in the car. There's a lot of different things you could do when you're a single person, or it's just you and your spouse or whatever. But when you have kids, it's a little bit different. Some other suggestions I thought of was revisit your monthly expenses and cut even more fat. I literally today went into my streaming TV servicer and cut one of the services. And it's something I probably should have done a long time ago. And it was hard, because one package had this channel that I watch, and another package had that channel that I watch.
You won't miss it.
I basically just rolled the dice and was like, all right, I'm going to take
won't
you.
miss it.
I don't think I will. And then also, you can, especially in a moment like this, if you're in a position to, you can refinance high dollar debt if you're able to, which might actually help you from month-to-month expenses. And then also just generally have a mentality to hunker down.
Yeah, I mean, you're right. Having the mentality to say, you know what, things aren't great right now. I'm going to avoid brunch this weekend, right? That $25, $30, $45, $50 brunch tab, just those bottomless mimosas will be there, a month from now. Let me just go ahead and, that's true too. That's part of it.
So a final question, because, part of this is, figuring out how to adopt some more wealthy attitudes into our mindset here on Manage Your Damn Money. Help me understand, and you kind of went through it with your Warren Buffett, Berkshire Hathaway example. Why do rich people like market downturns?
Well, I said it initially, but if you think about what you consume, if you go and buy shoes, for example, I know is a vice for you.
It used to be. It ain't no more.
Just as an example, for wealthier people, buying companies is a vice that they like to consume.
Wow.
So if I told you that these new retro Kobe's were on sale, 20% at, Foot Locker down the street, you can be like, oh, okay, I might want to go ahead and get me some of those. 20% off is enough to make me move my feet, and I would look good in some Kobe's. The same way wealthier people go, so-and-so is 20% off? Oh, I'm coming today. I would look good in that. It's the exact same concept. If you just think about the fact that $100 for you and whatever impact that has on your life is the equivalent of $100 million for a billionaire like Warren Buffett.
Right. And how do people take that attitude and implement it into their own goings on?
See, I think I'm glad you asked that, because I think it's important to understand that even though there's a huge disconnect, like I said, $100 in my pocket is a factor of 1,000 for a Warren Buffett or somebody.
Right.
But understanding that just because I'm not playing with the same amount of dollars doesn't mean that the concept isn't still a good one.
Doesn't still apply.
And so me having, a few hundred or a few thousand or tens of thousands of dollars available in a CD or in a money market account or something like that, just waiting for a great buying opportunity such as now.
Right.
I can still adopt that same behavior even though I don't have, the money that Berkshire Hathaway has sitting on the sidelines.
Right, indeed. And with that big piece of juicy wisdom, we're going to close this episode of Manage Your Damn Money. I would remind you can catch past episodes of the show on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. Please leave us a 5-star rating on any of those platforms. That helps more people catch our show. If you have a question or topic you want us to cover, send it to us, info@manageyourdamnmoney.com. You can always catch us on Instagram, Twitter. My handle's @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And you can always catch us on Facebook, facebook.com/manageyourdamnmoney. Thanks to our partners once again here at Montgomery Community Media for their amazing hospitality. And until next time, be good with your money.
Peace.
Peace.